Hi, good afternoon. This is Benjamin Lavine, CIO of 3D Asset Management. Welcome to our Advisor Success Series. In this program, we will be speaking with two ETF fixed income specialists from First Trust and Powershares to discuss the current fixed income landscape in light of what we've seen happen over the last year, particularly with the electoral outcomes in November. Just a quick background. We're 3D Asset Management. We're a strategic global investment manager. We run ETF portfolios for our advisor partners. Our investment philosophy has stayed consistent through the years, which is focused on long-term investing, global diversification, and as well as managing risks and controlling costs. We work with fee-based advisor community to offer the benefits of ETFs within a disciplined global asset allocation framework best fitted for outcome-oriented programs. So again, welcome to the 3D Advisor Success Series. First, I would like to welcome Paul McGinn, Senior Vice President of Institutional Investments at First Trust, and James Meyer, Director of Fixed Income Product Strategy and Invesco Powershares Capital Management. Welcome, gentlemen.
Hey, Ben.
Thank you. Happy to be here.
Today, we're going to discuss factors that have driven the rise in interest rates going back to the summer of 2016, and we'll outline some of the main risks facing fixed income investors today in light of the changing political and monetary environments. For those who have followed what we have published in our commentaries and blog posts, we have observed a resurgence in the so-called cyclical reflationary trade, and how reflationary forces and sentiment are butting up against the new normal secular disinflationary forces of aging demographics, high debt levels, and excess global capacity that have kept global growth to low nominal levels as well as kept a lid on interest rates. In essence, Trump versus bonds exemplifies this clash between these two tectonic forces of cyclical reflation and secular disinflation. In addition, we will educate the audience on the ETF products used by 3D that form most of the current exposure for 3D's fixed income ETF managed portfolios, namely senior loans as well as variable rate preferreds. So to start, in our mind, this chart serves as the fulcrum between Trump versus bonds. It shows the differences in yields between nominal treasuries versus Treasury inflation protected securities or TIPS, reflecting market expectations for longer-term inflation trends currently around 2%. This chart represents a favorite indicator tracked by the Federal Reserve to gauge implied inflation priced into the bond market. Prior to the June Brexit referendum, we had two notable sell-offs in risky assets, which we categorized as equities, commodities, and high-yield credit, back in September 2015, and January, February 2016. Mainly prompted by the surprise devaluations of the Chinese yuan, which can be seen on the left-hand side when inflation expectations dipped below 1.5%, suggesting the world was at risk in entering yet another deflationary episode. But since the Brexit vote back in June, market expectations have turned into cyclical reflation. First, global central banks shifted their focus from engineering negative rates to steeper yield curves in order to aid the profitability of financial lenders such as banks. This reflationary trade accelerated with the surprise November electoral outcomes as investors began to price in administration policies that would stimulate domestic growth and extend the current business cycle further out. In essence, what we have is Make America Inflate Again, which is a theme that we've been discussing in our last market commentary. In essence, what would make America inflate again are a combination of things. First, trade protectionism would raise import prices, inducing late cycle inflation. And we've already seen upward trends in private wage growth as well as employee costs, which include benefits as well as new minimum wage laws that were also passed in November. Finally, tax and regulatory reforms could unleash a new wave of industrial demand as well as potentially create new credit bubbles. But butting up against this are the forces of secular disinflation. This one shows the forces of high debt levels. Total U.S. non-financial debt as a percent of GDP has now reached unprecedented levels of 240-250% as represented by the blue line. The orange line represents the velocity of money. As a result of the high debt load relative to an economy that can service that debt load, the velocity of money, or how much incremental nominal GDP is gained with each dollar of debt, has seen a secular decline. This is otherwise known as the diminishing marginal return of adding debt capacity to generate growth. A second major force is aging demographics. This is from the United Nations World Population Report of 2015 concerning the latest aging demographic trends. The chart displays the accelerated growth in the 60 and over cohort versus the other age bands projected at 2050. According to the report, quote, in 2015, there were 48% more people aged 60 or over worldwide than there were in 2000, and by 2050, the number of older people is projected to have more than tripled since 2000. And much of the growth in younger populations will come from emerging markets rather than developed markets. This will test the developed market immigration policies. Hence, an older population and a higher ratio to workforce age bands will weigh on future consumption. There will also be less of a need to add on future capacity for the production of finished goods. Services such as healthcare provision are another matter. In addition, the IMF released a report showing the sharp decline in total factor productivity for the aging cohorts in Japan. As developed world populations get older, total factor productivity is expected to decline, which would have implications for world living standards. So those who believe in long-term secular lid on real rates may be tempted to buy sell-off in bonds, particularly if you believe the market is overly optimistic on Trumpflation, and that may be a winning strategy for investors seeking high total returns. Of course, there is always the risk that Trumpflation prevails, leading to heightened inflationary cycle. The market seems to be pricing in 2% inflation for the foreseeable future, based mostly on Trump administration policies, and the consensus view on Trumpflation seems to indicate that inflation could run higher. Yet it remains to be seen how robust this inflationary cycle will manifest itself in the face of secular disinflation. Finally, I just want to end with this chart, which shows the net speculative interest in Treasury futures positioning as of year end. Hedging interest rate risk may be tempting in a reflationary environment, but much of the losses have already been incurred in the fourth quarter, and shorting treasuries feels like a crowded trade, as indicated by the red circle. Not to mention that hedging interest rate risk now is akin to buying insurance after the catastrophe has already hit. Since we published this graph in our year-end market commentary, the 10-year Treasury yield has dropped from a high of 2.6% in late December to just around 2.4%, although it did spike up today following Janet Yellen's federal congressional testimony. So with that, I'm going to go ahead and provide the audience with just some current market figures before we get into a discussion with the panelists about the broader market background. So the U.S. 10-year Treasury yield is about 2.43% as of last Friday, although I did mention it spiked up a little bit today following Janet Yellen's testimony. The 2 to 10-year yield curve spread, or the term structure, is at 1.23%, down from a peak of 1.34 in mid-December. Spot oil is about $53.86 a barrel, which is near a recent high. The DXY, or the dollar spot against other major trade currencies, is a 100.76, down from a peak of 103 in mid-December. The 5-year forward break-even is about 2%, down from a peak of 2.15% mid-January. The Barclays high yield spread is at 3.34%, which is at the lows, and the BBB rated spread is at 1.54%, which is also near its lows. And so to begin this panel discussion, so I'm going to pose this question to each of the panelists, and I'll go ahead and start with James. How much of the sell-off do you view as fundamentally driven, given the shifts that we've seen in the political and monetary landscape, and how much do you view as overreaction to perceived outcomes?
Yeah, thanks, Ben. I think in general the market has been in a wait-and-see mode, as you mentioned, really since the beginning of December. And it's interesting, if you look at the shape and slope of the yield curve directly following the bloodbath that was November, when rates spiked across the term structure and was the worst month in global bond market history in terms of total performance. Since that time in early December, right, flash forward to now, we're almost exactly the same slope and shape of the yield curve as we were at that point. So I think that highlights the divisiveness in the market currently on how growth optimism under the Trump administration will impact inflation and the real indicators that the Fed is watching to determine monetary policy. I think it's really going forward a tale of two curves. I think that the sell-off we saw in November was certainly warranted in terms of expectations for the Fed at that point to hike 3 or 4 times this year. If I look at now with the expectations for the first hike or the next hike in this cycle, the first hike this year coming in June, the market and economists and the Fed are in a wait-and-see mode to see how inflation is really impacted. With inflation, headline inflation recently printing up above 2%, there certainly is expectation for higher inflation. As Ben mentioned, inflation expectations have gone up above 2% if you look out from, say, 1 year out to 30 years forward, based on the break-evens that we analyze. So I think right now it's a pretty much balanced outlook. The low end, you're expecting 2 Fed hikes. On the high end, you're expecting 4. I think it'll probably end right in the middle. And what I think is the reaction we saw in November was warranted based on expectation. And we've since seen the 10 and 30-year part of the curve settle down. So when I say the tale of two curves, what I mean by that is I think the short end of the curve, or what we call the belly, which is really the 2 to 7 year portion, those rates are biased higher, and in general that is going to be driven by, 1, the Fed hiking 2 to 4 times, 2, ongoing short-term funding pressures in the market with some indicators that we look at, such as LIBOR, which is the rate at which banks lend to each other. There's still a very much perceived difficulty in financing in short-term funding markets, along with optimism over the economy. So I think that 2 to 7 year portion of the belly of the curve, which hadn't got hit as much in November, will continue to grind higher. Conversely, I think the long end of the curve, when we look at the 10 and the 30-year bonds, which really have been volatile but have been well bid, mainly from these institutional investors, I think the long end of the curve will remain relatively well anchored, and that'll be driven by institutional demand. Institutions like pension funds and insurance companies that have very long-dated liabilities. Anytime their rates go up, the present value of those liabilities, or how much they owe in the future, goes down because they're earning a higher rate of return. So in that environment, those types of institutions tend to de-risk out of equities potentially into fixed income, and they try and lock in those yields. So I think that bid for the long end of the curve will remain present throughout the year. And in the end, I envision a flatter curve overall as the outlook for this year.
Okay. Paul, go ahead and pose the same question to you. Do you view the sell-off that we saw in the fourth quarter as fundamentally driven, given the shifts that we've seen in the landscapes, or do you think it's an overreaction?
Sure. Thanks, Ben. And really going back to last year, one of the risks that we have been discussing for quite a bit of time is the bond market has been priced for protection, really coming into the third, fourth quarter of last year. And the key risk, at least in our eyes, was any hint of inflationary pressure, some of which you alluded to, could certainly have a substantial impact. And so what we started to see were certainly some green shoots, with employment running at about, our unemployment running at about 4.8% as of January. Most people deem that full employment. The naysayers would say there's some debate about, labor participation rate, but nonetheless, we think we're looking at basically full employment. That combined with wage growth, consumer spending, overall inflation continuing to trend higher, which you alluded to, clearly has had an impact. And that was our call before the election results. And then, those of you who are familiar with Brian Westbury, our chief economist, he did a lot of work in which he really labeled it a plow horse economy. And then subsequent to the election, you basically have some reflationary impetus in terms of President Trump's fiscal stimulus plans, which are arguably a catalyst for driving that move, which has been characterized by deregulation, lower taxes, infrastructure spending, all of which is implemented successfully, could move the economy from what we deem a plow horse economy into a racehorse economy, to borrow some of Westbury's verbiage. Lastly, and an impact certainly has been in the past, maybe no longer, the infamous carry trade, where you had a tremendous amount of demand for U.S. Treasuries by foreign entities, and foreign entities today hold about 43% of the U.S. debt outstanding. And really last year, they went from being net buyers to net sellers. So for all of 2016, you had about $200 billion in net negative activity, which is really the first time we've seen this since really going all the way back till 2000. So most notably, the two largest foreign investors, which have been China and Japan, China's been dealing with net capital outflows, putting pressure on its currency, and to combat this, they're drawing down on their foreign exchange reserves, much of which was invested in U.S. Treasuries, i.e. creating more selling. Japan has been balking as well. So all of these things combined certainly contributed to that fact, and at the end of the day, the net of it is we don't see it the move as an overreaction per se. We see it more along the lines of an adjustment to the new realities of what we have in today's environment.
Okay, thank you. Just expanding upon the Fed for a moment, we did see in Janet Yellen's testimony today that she did put a March rate hike back on the table, and the Fed funds futures had been pricing in a low probability, call it maybe 25-ish%, that the Fed would raise rates by 0.25% in March. So the question now is up until more recently, it seemed like the Fed funds futures was ahead of the Federal Reserve itself in forecasting anticipated Fed hikes. Do you think now in fact, the Fed funds futures could be, in fact, be behind the curve when projecting near-term Fed policy? Because last dot plot showed about 3 rate hikes being priced, being expected by the Fed, as opposed to 2 that's being priced into Fed funds futures. I'll go ahead and, James, go ahead and respond first.
Sure. Yeah, I mean, I think it's a very interesting point, and just to give the Fed their due, I think their mandate is about as complicated and complex as it's ever been. You know, they've become really a global central bank, and the ECB, the Bank of Japan, Bank of England are all really looking at the Fed to drive their policies, and you know how they reduce quantitative easing and really get the global economy and the financial market less addicted to liquidity and more looking forward. So more than ever, their mandate is difficult, and if we look at their core mandate, it's controlling inflation right around that 2% level. So if we look at the inflation indicators that they're watching, which is primarily the PCE core indices, those are still well below 2% at about 1.6. Even though headline inflation recently ticked up above 2%, including food and energy, the core level is still relatively low. So I think the futures, the Fed fund futures, are really looking at growth and inflation and not looking at that global picture. But in reality, the Fed is going to need to be cognizant of the global macro risks, and therefore I think they're going to be more cautious and more data dependent than they've ever been. Obviously, Yellen and her testimony is alluding to the fact that a hike in March is still on the table, but that's just their need to be vigilant and employ Fed speak that keeps the market well grounded. They're trying to keep rates in a relatively stable range until they get the pass-through from growth to inflation and have the complete picture to see when and if it's appropriate to hike. So I think the fact that we're not looking at an expectation for a hike until June is probably reasonable and indicative of the polarization in the rate market right now. You have the long end, the institutional investors are pretty much going long duration, betting that rates are going to drop. And conversely, you've got the hedge funds, the leverage community, or short duration, betting that rates are going to go up. So I think it's really built into the Fed's expectations that we're in a wait-and-see mode, both here and abroad with what's going on in Europe, potential polarization within the Euro area and those countries. There's so many macro, what we call tape bombs that could emerge, that the Fed is going to be very cautious and deliberate with this next hike. And I think that the market has it right, that we probably won't see the first hike until around June, but then you could see 2 or 3 weighted in the second half of the year.
Okay, Paul?
Yeah, no, it's a great question, and one that's kicked around a lot. And I would agree with James. The Fed's job today is far more complex than ever, especially if you go back to pre-crisis. And one of the things that you'll hear people banter about is the Taylor rule. And for those of you who may not be familiar, John Taylor was a professor at Stanford. He came up with a formula that many have set really is the standard by which short-term rates should be set. And so people became accustomed to kind of following that, and that was the best way to track the Fed. And so if you're a believer in the Taylor rule, the answer would clearly be yes, the Fed is behind the curve, because the Taylor rule today prices in Fed funds rate at about 3.75% to 4%. But clearly that's not feasible in today's world for many of the reasons James just alluded to. And the net of it is, during the 2008 financial crisis, a lot of unprecedented things took place. You had a zero interest rate policy. You had QE, where you had a purchase of trillions and trillions of dollars of bonds to influence long-term rates, et cetera. And back then, the Taylor rule indicated rates should have been a negative 2%. So regardless of if you're a believer of the Taylor rule or not, it's really some of the more conventional wisdom, which was used in the past to kind of track, many of the people carry forward today, and it's not necessarily applicable. So today, as you mentioned, the forecast implies 3 rate hikes for a total of 75 basis points, which would bring Fed funds to call it 1.5%. Still well below that Taylor rule expectation of 4% today. So while we believe the market is more than likely priced in some potential Fed rate hikes, a more aggressive Fed, meaning if they were to do anything additional or above what is anticipated, priced in the market, and currently forecast, could create some serious damage and cause some unrest. And we believe over time, you will kind of have this mean reversion as it relates to the Taylor rule over the coming 2, 3, 4 years as we continue to grow out of the cycle, because 2008 was an extreme event.
Okay. This is a good lead-in question then. Last time we saw the Fed be more aggressive than what the market had anticipated, in essence, the price was, I would say, back in 1994. And so my question now and I'll start with James, is where are the main risks in the bond market, apart from kind of the 2 to 7 year part of the term structure, should the Fed choose to be more aggressive than was currently anticipated by the bond market?
Yeah, that's a great question, and I think it kind of highlights our major macro theme for fixed income this year. I think the main risk in fixed income is having inertia within your fixed income allocation and really just going with a purely passive index-based allocation. If we look at what we call the core of the market, which is based on the Bloomberg Barclays U.S. Aggregate Index, up to right at this point, just under 70% of that core metric that we use to measure the market is in U.S. Treasuries and mortgage-backed securities from Fannie Mae and Freddie Mac. That's a staggering figure. So if you're just allocating to a passive index allocation to a product linked to that index, you have almost 70% of your investment centered in very interest rate sensitive sectors, which are treasuries and mortgages. I think the lessons from last year are imperative to look at as we kind of formulate our investment strategy for this year. Because if you look at last year, the Ag Index was up just over 2%, about 2.3%, but treasuries and mortgages only advanced about 1%. And most of that wealth was eroded in November, as we've discussed, with the rate spike. But I think it paints a picture of duration risk in this market. And if you're just passively allocated to treasuries and mortgages, my expectation is that your portfolio will underperform this year and might even, return less than 2%. You might be happy with 1 to 2% in fixed income. So a lot of people look at their allocation to fixed income as, well, I don't want to lose money. Well, there's a chance if the Fed is more aggressive and inflation surprises on the upside and we don't get those global macro shocks, that we do get 4 hikes from the Fed or even 5. I don't think it's out of the question. It's not our base case. But in that environment, if you're invested in the ag with a duration of 6, and rates go up 100%, 1%, you're losing 6% on your portfolio. So I think that duration risk and that allocation to the core is going to hurt investors this year. So the message we're trying to get out is you need to be diversified into what we call the non-core sectors, things that are more tied to credit spreads, tied to the U.S. economic performance, tied to really technicals that are highly skewed towards this hunt for yield and looking at spread products and things with yields and spreads above treasuries that have a little bit of an interest in a spread cushion to offset your losses on principal. So the theory is fixed income returns are a combination of your principal return and your interest return. If you're in a long duration product where your principal is dropping as rates rise, you want to have a higher interest return and what we call interest rate carry to offset some of those losses and keep you in positive territory. So that's the message we're trying to get out, and I feel that the main risk in the market is being a passive investor and having inertia and really being focused on a core that I think will underperform this year.
Okay, that's interesting. Paul, what are your thoughts?
Yeah, no, clearly the biggest risk today is more rate than credit. And for the last 20, 25 years, people have been conditioned to think about risk predominantly from a credit perspective. And, going back to the aggregate, the Barclays aggregate, if you will, today your unit of income per unit of duration risk taken is at its all-time lowest level, which is quite ironic because if you were to go back to the Carter administration and you had long-term treasuries trading at 15%, your unit of income received per unit of duration risk taken was at its all-time highest level, but yet nobody wanted to own bonds because they thought rates were moving higher. Fast forward the movie today, it's a stampede into the fixed income environment, and with that rate risk outstanding, most funds that are core funds, as James alluded to, are nothing more than rate bets. And so, the bond market would clearly suffer. Investors would retrench if you get a more aggressive Fed. And while historically gradually rising rates in general is a very good thing for income investors as reinvestment proceeds go into fatter coupons, which helps to mitigate volatility and so on, from a psyche perspective, people have historically been okay with this as long as the principal investment does not erode at an optically higher rate in which the coupon reinvestment can be meaningfully offset. And with historically low coupons, you get a shock in the rates and you're going to have a rapid principal erosion. This could in turn send some fear and panic and selling in the marketplace. People would begin to balk and you would have waves of redemptions that would tend to kind of feed on themselves. So, as a result, we tend to favor lower duration credit fixed income assets with meaningful coupons to not only offset the volatility, but potentially participate in any increase in rates, i.e. loans.
Okay. Shifting gears for a bit, because we've had some advisors express some concerns about what is happening in the tax-free municipal bond space. And to the extent that you can comment, we'd be interested to hear your thoughts as to whether what we're hearing from the Congress and from the Trump administration about their proposed tax agenda, how within kind of this current rate environment, what do you kind of sort of see as the relative appeal of tax-free municipal bonds, given that, some of the tax proposals, for instance, are threatening to withdraw the tax-free status that state and local municipal bonds have enjoyed. I'll go ahead and start with James.
Yeah, it's a great question and a very hot topic now, Ben. I would say that tax-exempt municipals have sold off of late, and one of the ways that we track the market is to look at ratios of tax-free munis to treasuries, both AAA rated. And when we track those ratios right now in the 30-year or the long duration muni space, you're getting about 105% or 5% more in munis above the treasury. And if you look at 10-year munis on average, it's just about 95%. So if you make those on an after-tax basis, right now the muni market looks cheap because your after-tax yield is going to be as much as 1 to 1.5% above the 30-year treasury for similar credit risk in that sector. So from a valuation perspective, the asset class is cheapened considerably, and in our opinion, we think it's a buying opportunity, particularly because any of these tax cuts, both at the individual or the corporate level, right now are just proposals. There are some that we think have a better chance of being passed than others. In particular, the reductions in the tax exemption benefits of munis. We don't think that has as much legs as cuts to the individual and corporate tax rates. But really, any way you slice it, if you look at the municipal buyer in terms of the high net worth investor, who's the heart of the market on the retail side, their effective tax rates are already mostly lower than that 39% number that's been thrown around. So I've seen a lot of research pointing to it's more like a 25 or 30% tax rate effectively currently. So in that environment, even if tax rates are cut, the demand for munis will still be relatively resilient. And if you turn to the institutional side of the ledger, insurance companies are huge buyers of municipal debt, particularly the property and casualty insurers, where they have a higher effective tax rate. So the tax break that they get from municipal securities is a huge part of their investment strategy. Even if corporate tax rates were cut, there'd still be demand just given the attractive spread you get in munis compared to treasuries and the fact that they give you that long duration exposure that they need to match their liabilities. Two ways to slice and dice the market that we like right now. We have a focus on revenue bonds over general obligation debt. General obligation debt is your state and local taxing authorities that are reliant really on growth and taxation for revenues, compared to revenue bonds, which are really tied to specific projects such as toll roads and water and sewer facilities. So the demand for those products and the revenues they earn tend to be more inelastic compared to growth, tend to be more steady. So that's a sector that we favor overall. But I mean, in general, I would say that I would view this as a buying opportunity, even if tax cuts are imposed at the individual and corporate tax level. We still think there will be decent demand. And on the supply side of the ledger, there's been very little municipal supply as all the issuers await future proposals from the administration. So right now it's a buyer's market in munis, and we think it's an opportunity.
Okay. And Paul?
Yeah, thanks. It's again, it's a great question, and when we think of potential proposed tax plans, we basically put the potential impact in three separate buckets. The first bucket would be the personal income tax reform that would result in a lower top marginal tax rate for individuals. And certainly the probability of this, we believe, is very high. Although we see the impact as being relatively insignificant, because we actually have a precedent for this where we had a very similar situation with the Bush administration back in 2001 and then again in 2003 where there was relatively little impact. And this is probably, and we've done a fair amount of research on this, because the average tax rate for municipal holders is actually much lower than the top marginal tax rate, likely around 23 to 28%. And that really hasn't changed over the years. So whether it stays at 39.9% or if it moves to 33%, it really shouldn't have an impact. The second bucket, which we break down into the personal income tax reform that results in a cap or really a cut to the benefit of the tax exemption, we would assign a very low probability there, meaning basically we see no imminent threat to the tax-exempt status of municipals. Now, that being said, we do believe that the threat to the tax exemption is probably greater now than any time since 1986 when the Reagan tax reform package was enacted with new restrictions for issuers, investors, etc. However, most members of Congress understand the importance of the municipal market and that traditional tax-exempt muni bonds remain the primary tool for the financing and construction of schools, other basic infrastructure needs, which is a big component of the campaign promises put forth by the administration. So again, we assign relatively low probability to that. And then the last is really the corporate income tax reform, which will lead to corporate tax cuts. Again, we think this is a high probability and is likely to have a more significant impact on the muni bond demand by banks and insurance companies. Banks, property and casualty insurance companies currently comprise about 24% of the holdings of the municipal markets. I want to say it's about 3.8 to 4 trillion in assets, which is enormous. Now, depending on how low corporate tax rates are cut, future purchases by these two, call it institutional buyers, if you will, could be curtailed. But it's important to remember or to note that the average property and casualty company already pays a relatively lower tax rate on average than other corporate entities. I want to say that tax rate comes in around 20 to 25% range. So that's a very long way of saying the appeal of tax-free munis is not going away anytime soon. And if history is any indicator, anytime you get a backup in spreads, and it's a greater advantage from a taxable equivalent yield, you see it met with a healthy level of demand, primarily driven by the retail high net worth investor.
Okay, thank you very much. So one final question before we turn to the subsector reviews. Want to get, just for the audience to educate them on why do ETFs make more sense for getting exposure to fixed income markets as opposed to regular open-end mutual funds? And I'll start with James.
Yeah, this is another great question and one that we get from clients all the time. Just in terms of the three tenets that we look at to really frame the benefits of ETF investing in fixed income rather than transactional investing. First and foremost, the benefit comes from liquidity. The liquidity in the fixed income market, which for those of you who aren't familiar is largely what we call an over-the-counter market, by which a buy side and a sell side would be paired up either directly or through a broker to purchase and sell bonds. And this is in direct opposition to the equity markets, which are largely automated. Bond market trades are still largely done, almost 70% of them, either over the phone or through very, broker-to-broker or investor-to-investor platforms that are smaller and more focused. So it's very much a market driven by supply and demand, and the broker-dealer community has been taking a much smaller part in terms of reducing the inventory of bonds that they hold for investors to buy and sell. And so what it's resulted in is liquidity in the secondary market for fixed income is about as bad as it's ever been. And it's only getting worse as the demand for bonds from institutions and retail investors skyrockets, and the supply of bonds just can't keep pace. And so with that supply-demand imbalance, the benefits of the ETF structure rather than trying to do transactional fixed income is that for the large extent, you remove the transactional risk in fixed income as an investor and instead entrust an ETF fund manager to manage those assets and do those trades for you. And in some cases with some ETFs, once they get to a large enough size and scale, the majority of the trading is done in the ETF shares rather than having to buy and sell bonds. And this can be helpful when you get into markets such as high yield bonds, preferreds, and bank loans, which have less liquidity than your standard treasuries, mortgages, and corporates. So the benefit of the ETF structure, it gives you that, obviously, the intraday trading ability and valuation. It helps provide price transparency to the market. You can look at your list of holdings every day and find out exactly the bonds that are held in your portfolio. And a lot of times the ETF trading will actually give you price marks for bonds that would just have been squirreled away by an investor and might not have been bought and sold. And that's a key difference with equities, where equities are traded every day throughout the day. There could be bonds that are just bought and held by enough investors where they don't actually trade. So it also adds transparency to the market. And then third point I'd like to make here is really the lower fees that the ETF wrapper provides compared to actively managed funds, whether it be through a separately managed account or a mutual fund. As the fixed income ETF market has exploded, and last year it was the largest inflows into fixed income ETFs that we've ever seen. As that market grows in size and scale, you have more and more options to slice and dice and get into very particular sectors and subsectors to really come up with a model allocation that can match what a mutual fund would do in, let's say, a total return or unconstrained mandate, where it's a go anywhere. You can replicate that now with ETFs, either from a holistic standpoint or in very targeted investments, a lot of times at lower fees than actively managed products, and give you that customization where you know through the transparency mechanism exactly what's in your portfolio, rather than relying on a mutual fund, which might give you quarterly holdings and might be 3 months behind. So I'd say that, just to rehash, benefits of 1, liquidity, 2, transparency, and 3, lower fees with the customization to really know what you're allocating to.
Okay, and Paul, do you have anything to add?
Sure. Certainly agree with the liquidity, transparency, and fees. And the one thing that I would just say additionally, and we can say this because we actually manage both ETFs as well as mutual funds. And from a active manager's point of view, in the mutual fund wrapper, you can also have what we refer to as a forced liquidation. And so anytime you have a net seller in the market, at the end of the day, the fund manager receives a sell order, and he or she needs to wake up tomorrow morning and sell something. And so any trade, whether it's a buy or a sell in a mutual fund, the portfolio manager feels that and is forced to either liquidate or add. And conversely, in the ETF sector, and there's been a number of studies that have been done on this, you have the authorized participants and the market makers in place who are paid to take risk. And so if you have a wave of redemptions that are coming into the market maker, he or she may have natural buyers on the other side. And it's not uncommon that we can walk in and see, 200, 300, 400,000 shares of our fixed income ETFs trade, and we don't get a create and or a redeem. And so certainly from a buffering volatility and creating a more efficient marketplace, that is a big plus, which then gives the manager of the fund more time to which to invest in managing the portfolio. So I think the study says, or the studies that I've seen, for every $10 of a mutual fund that transacts, approximately $10 of underlying securities transact. For every $10 of a fixed income ETF that transacts, approximately $2 to $3 of an underlying security actually transacts. So it does tend to generate less volatility in the overall scheme of things. Now, that's not to say that if you have a similar situation like 2007, 2008, when markets go down, asset prices get depressed, ETF asset prices will get depressed as well. But the portfolio manager does have far more tools at his or her disposal in which to manage that risk.
Perfect. Thank you very much. That wraps up our general questions. And I want to give an opportunity for the panelists to help educate our audience on the subsectors that our fixed income ETF portfolios are invested in, namely variable rate preferreds and senior loans. These are 2 sectors that really benefited our performance last year. And so I'll go ahead and start with First and Powershares. And what the panelists will present is just a brief explanation of the subsector and what makes that sector appealing to fixed income investors. They'll also highlight the main risks associated with the subsector, what specific aspects of the subsector does their ETF provide to investors, and why they believe that their ETF presents a more attractive option for gaining access to the subsector versus other ETFs. And I'll go ahead and start with Paul at First Trust to discuss senior loans.
Sure, thanks, Ben. Senior loans, often referred to as leverage loans or senior floating rate bank loans, that they're all essentially the same. Loans are arranged by banks and they're sold to a variety of institutional investors. The borrower is not the bank itself, but rather a business, oftentimes household names like Hospital Corporation of America, PetSmart, Hilton Hotels, etc., whose debt is typically rated below investment grade. And on average, loans have the maturity of 7 years when issued, and the interest rate is paid by the borrower floats at a predetermined rate above LIBOR, basically 3-month LIBOR in most instances. And since most loans reset or float above the 3-month LIBOR, the sensitivity of these loans to rising interest rates is generally very limited, which is one of the many characteristics investors find appealing. And if we can move to the next slide, I think other benefits that investors find very appealing is a very low correlation to other fixed income asset classes. So in terms of part of a well-diversified fixed income portfolio, certainly these unique characteristics apply. Meaning basically high income, senior secured in the overall capital structure, low duration, low correlation to other fixed income asset classes with the potential to increase income in periods of rising rates make a very compelling case in an environment like we have today. And if you take a look at the next slide, what this really takes you through is if you go back over the last, call it 5 periods of rising rate environments, if you will, you can see that senior loans have and continue to be one of the best performing fixed income asset classes for these very reasons.
Would also note that senior loans can benefit from rising rates as highlighted by this chart. We are looking at in a potential rising rate environment. One of the things that makes one of the characteristics of a senior loan is that they have what are known as LIBOR floors. And in the low rate environment that we've been in, many senior loans have actually have their rates, have a floor set to their rates so that in the subsequent initial rise in short-term rates, senior loans didn't initially benefit because the LIBOR floor was still higher than the prevailing short-term rates. Well, most have floors set around 1%. We've just seen 3-month LIBOR breach that 1% level. So in subsequent rate moves with the Fed raising rates, presumably LIBOR will track that. Now senior loans will start tracking those rates because they're above the LIBOR floor. Is that correct, Paul?
That is correct. And it's basically been, as you alluded to, since 2009, loans have not been a true floating rate asset class. And this is dynamic because historically LIBOR, at least 3-month LIBOR, would move in lockstep with Fed funds. And if you go back to December of 2015, 3-month LIBOR was trading at 33 basis points. And so with the Fed rate hike in 2016, people looked and said, well, the Fed's going to continue to kick the can down the road, and I don't anticipate that these things reset anytime soon. Now, LIBOR stopped moving in lockstep with Fed funds and quietly crept up to 88 basis points before we had the most recent Fed rate hike, and today we're just north of 100 basis points at about 103 or 104. So call it 95, 96% of the loans in the outstanding marketplace today are true floating rate asset classes.
And we would just note too that senior loans, generally the default rate tends to be lower over time than regular bonds. That's partly because of the seniority and the cap structure. Bonds, senior bonds and subordinated bonds will take losses before the senior bank loan lenders end up taking a loss.
The one keynote that I would add there, Ben, is we get a lot of questions about the capital structure. And as you alluded to at the beginning of the call, with high yield trading at a spread of about 350 basis points off the underlying, in many instances, and when issuers come to market, it's not uncommon they issue both a tranche of high yield as well as senior loans with the underlying. And today, in many instances, you can move out of high yield into senior loans, move up in the overall capital structure, have credit protection from the standpoint of you have a secured underlying, take out similar yields, and get a floating rate instrument in an environment where we believe rates will continue to trend higher. And so it's certainly a unique point in the cycle, and it's a rare event when you see from a relative value standpoint where the spreads in the loan markets are actually wider than spreads in the high yield market. That combined with the relatively benign default market going forward bodes quite well, we believe, not only for credit assets in general, but in particular senior loans.
Perfect. Would you also say that loans tend to track the total returns of high yield bonds over time, but with perhaps less volatility?
Absolutely, absolutely. And so, you know, where you have something like high yield, if you go back over the last 25 years, you know, high yield has really kicked in annualized returns somewhere in the realm of 7 to 7.25%. Versus the S&P 500 index, which has come in at about 7.5%. However, the volatility and or drawdown in high yield has been about half that of the S&P 500. And so really this time last year, you saw a huge wave of money moving out of equities into high yield when spreads were at historically wide levels. Now, loans being another credit asset that is non-investment grade, they do track, but you have the coupon reset, you are senior secured, and you have the floating rate instrument, so they come in at a far less volatility than your high yield brethren. And if you go back and look over the last 20 years, there's only been 2 instances where you had negative returns in the senior loan market, and that was still relatively benign with the exception of 2008. However, if you were to close your eyes and hold through the 2008 time period, in 2009 you had meteoric returns.
And in terms of why a First Trust ETF as opposed to a passive one that weights securities based on their debt outstanding, what kind of sort of highlights some of the characteristics of FTSL and why you believe your approach makes more sense?
Sure. So in terms of ETFs, FTSL, Ben, which you alluded to, is our actively managed senior loan product. And while there's many different ways to invest in the markets, and we talked about some of the differences between mutual funds and ETFs, in the ETF realm, you have actively managed ETFs and you have passively managed ETFs. And one of the things that we alluded to earlier is in fixed income investing, index investing, in particular as it relates to senior loans and high yield, unlike equity, where you actually have merit-based ranking and inclusion, in fixed income, the indices are debt capitalization weighted. So the net effect of that is whoever has the most amount of debt outstanding, irrespective of their ability and or willingness to repay that debt, okay, is going to have the highest exposure. So a real life example was if you go back to, call it 2008 and 13, in were to buy into a passively managed index, you would have received 7.5% exposure to Texas Utilities, which was a vintage 2007-2008 LBO at par. And so subsequent to that, Texas Utilities filed for bankruptcy. And in a passive mandate, there's no manager behind the curtain to make that adjustment. So the index makes it for you. So you would have bought in 7.5% exposure at par. You file for bankruptcy, it trades to 40 cents on the dollar, the index reconstitutes, gives you a 3.5% exposure, and so the net effect of it was you bought at the top and you sold at the bottom. And so where this really becomes meaningful for investors is with an index product, any index product, the best you can hope to do is index minus fees. In this particular instance, in order to recoup that loss in Texas Utilities, you would need 120% return. The average recovery rate in senior loans is going to come in about 60 cents on the dollar, and high yield it's going to come in around 40 to 45 cents on the dollar. So when you look at your MPT statistics, meaning upside downside capture, it's not uncommon that you get 90 to 100% or 90 to 95% of the upside capture in a passively managed product, but inevitably you'll get anywhere from 105 to 140% of the downside capture due to that compounding effect. So from an actively managed standpoint, where we believe we have and continue to shine is by delivering far superior risk-adjusted returns. From the standpoint of fixed income, it's all about capturing the coupon and avoiding the loss. And so when you look at FTSL, we've been able to generate alpha in all down markets. Basically, we're getting approximately 85% of the upside with just approximately 55% of the downside since inception. Okay, in addition to that, FTSL has the highest Sharpe ratio versus all senior loan ETFs since inception at 1.29. And again, unlike the index-based competitors, it's a very disciplined approach in terms of avoiding the companies that issue the most amount of debt in favor of those that we believe are the most likely to repay their debt, has and continues to result in better returns and lower volatility.
Okay, thank you. So I know we're running a little over here, but I'd like to at least have some time spent on variable rate preferreds, because this is a complex area of the market. Not a lot of exposure is given to this space, and so I'd like to have James, give a similar presentation in terms of the characteristics of variable rate preferreds and sort of what stands out with Powershares' approach in terms of investing in this space. James?
Sure. Thanks, Ben, for the opportunity. So the asset class we're talking about are variable rate preferreds, but in essence what they really are preferreds that were issued with a fixed rate coupon originally that converted to a floating rate coupon over time. So a preferred security is a hybrid. It's basically in between bonds and equities in the capital structure. So it is subordinate or below repayment compared to bonds, but above the repayment compared to equities. So it's what we call a hybrid security. The majority of the history of the market has been focused in what we call the $25 par preferreds. So these are in increments of $25. They're really issued more towards the retail segment of the investor base, and they're issued with very long fixed maturities, but they pay most of the time monthly dividends that is akin to interest income. So the attractiveness of preferreds over time has been the fact that they are a little bit lower than bonds in the capital structure, so you historically have earned a more attractive spread compared to bonds for similar rating because you're taking that capital structure risk. At this point in the cycle, the main risks with the sector overall, one, first and foremost, is rates. The preferred market tends to be highly correlated to 10-year treasury moves, and if you expect rates to spike up, particularly on the long end of the curve, like we had in November, then preferreds will sell off, and we saw that in November when preferreds actually fell off about twice as much as the core ag that we've been discussing. A second risk to the sector is call risk, and at this point with rates rising, that call risk is somewhat mitigated. but anytime these fixed to float securities convert to their floating rate coupon, the issuer has the ability in most cases to call those bonds. The fact is, given the financial regulation we've had in the market, the banks have been really incentivized to keep these securities outstanding as a way to help improve their capital ratios, because these securities, as I mentioned, are subordinate to bonds and can absorb some of the risk in a risk-off scenario.
Yep.
So the call risk is mitigated. The last risk is financial stress, kind of what we saw in the 2008 to 2010 scenario. We view that risk as relatively mitigated, but if you feel that the financial sector here in the U.S. and in Europe is going to run into trouble as QE is potentially pulled back and rates rise, then that's a third risk to the asset class. What makes VRP, which is our fixed to float product, unique is that it's the only ETF in the market that is benchmarked to this particular fixed to floating rate market. Currently 30% of the fund is floating, and what that means is it was issued with a fixed coupon, but it has since converted to float off of a benchmark rate, primarily 3-month LIBOR, which, as Ben mentioned, is ticked up above 1%. And in addition to that, you're getting on average about 3.5% to 4% over LIBOR in these securities. So it's an attractive spread product. Another 10% of our portfolio will float over the next year, so roughly 40% by the end of this year will have converted from fixed to floating. And what that does is it lowers the duration of the portfolio versus your fixed rate, because floating rate securities, the coupon will adjust as rates rise, and therefore your interest rate and duration risk is much lower. So on average, VRP has a duration about a year to a year and a half shorter than a fixed rate preferred product, and that has helped it outperform, particularly incorporating November's rate spike. If we take performance including November through today, VRP has outperformed most competitors by almost 0.5%. Another unique exposure in this product is there are recently, in the last couple of years, a new market of $1,000 par preferreds. So these are really hybrid securities that are more like bonds than they are like preferreds. And a lot of these were issued in this fixed to floating rate structure. So the portfolio gives you about a 40% exposure currently to this institutional or $1,000 par preferred. Those, since they're more like bonds and rates have been stable, have a relatively stickier asset base that tends to perform better when rates rise, because institutions are more buy and hold and less reactive in general than the retail community, who is more rate sensitive. So overall, I think this portfolio is really unique in terms of its exposure. It's an asset class differentiator. The average rating is just below investment grade on average, or BBB minus, just above, depending on the composition. So it does have some risk to it, but we feel that since the long end of the curve is going to be, in our opinion, relatively stable, that this asset class with the floating rate exposure, the exposure to this institutional par market, and basically the rising LIBOR and potential for higher income and yield as LIBOR rises, provides a very unique asset class exposure that doesn't really fit into any asset allocation model, and therefore should be a part of really everyone's asset allocation model because of that unique correlation benefit.
Okay. And just by way of background, most of the preferred market is comprised of financials. Would you say about 85% of issuers come from financial institutions, banks, insurers, and so forth? Given that, what prospects of sort of regulatory rollback of Dodd-Frank and others, what sort of effects would you see happen at the sort of the credit worthiness is perceived by investors on the preferred rate side?
Yeah, I think it's a great point. Certainly there is the potential for a rollback of regulations under the Trump administration, and broadly speaking, that would be obviously very supportive for the financial sector. We've seen that reflected to some extent in equity valuations and performance in financial markets, both here in the U.S. and abroad. So if the regulations are curbed, and with a steeper yield curve, banks would have not only better returns on their loans with higher yields, but less regulatory need to issue some of these lower tier securities like these contingent convertibles, which are below preferreds and really convert to equity in a risk scenario or a default scenario where there's a reduced liquidity. So we would look at the potential upside in the financial sector as a net positive for preferreds in terms of credit worthiness, although we do want to mention that preferreds are firmly a low triple B or high double B asset class, and we don't see the rating agencies really adjusting that view on where they sit in the capital structure, given that most large cap banks now are either low single A or high triple B on their outstanding debt ratings.
Okay. So thank you for that. We want to give a time to the audience members to submit any questions that they may have to the participants. If you look on the GoToWebinar dashboard, you'll see a question box. You can type in your questions, and a couple have come in so far. So we'll go ahead and take a few minutes to answer some questions. First question we have is, do you see worldflation, meaning inflation across global markets, or is it just happening within sort of specific countries or regions? And I'll go ahead and start with James.
Yeah, I mean, in general, I don't think that inflationary trends outside the U.S. are worrisome, particularly with Europe still lagging between the core and the periphery, and the Brexit impact on financial markets in Europe. I think we've seen some building signs of potential inflation, but if you look at the major developed markets, Japan and Europe, there's really no nation signs of inflation that would cause any of their central banks to pull back their quantitative easing any faster and or potentially raise rates akin to what the Fed is doing. So I don't see the global reflationary trend as something that right now is a concern on our end.
Thank you. Paul?
Yeah, no, I would agree with that. I think really the U.S. historically has tended to move much faster than the European counterparts, predominantly being you have less constituents in which to deal with. And so we generally tend to adjust, and I would argue there's kind of a lagging effect throughout all of continental Europe, and then when you go to Japan and the rest of Asia, there's no signs of inflationary pressures in sight. As a matter of fact, Japan has been kind of in that deflationary spiral for the past 25 years, if you will. And so while we hope that changes, I don't anticipate it changing soon.
Okay. I would just add, though, that one particular worrisome area for inflation would be China, where we've seen their CPI increase year over year to 2.5%, which is at the fastest pace since May of 2014. And in particular, their producer price index is up 6.9% year over year. Granted, this could just reflect a lot of the inflation, commodity price increases that we've seen in energy and other base materials. But what prospect do you think we could see inflation becoming more of a systematic problem in a place like China, where they are grappling with what is perceived to be rising bad loans amid inflating property values and so forth? And could a potential inflation scare in China kind of be the one catalyst that would cause a major systematic risk to their financial system? James or Paul, do you have any views on that?
Sure, it's a great question, and it's the age-old debate because we see lots of numbers kicking around in terms of China's GDP and what is real and what is not. I think the net effect of it is they certainly have and continue to grow at a very rapid rate, although we would argue it's a much lower rate today than it was a few years ago. And at First Trust, we actually fall into the camp of we don't see things continuing to move at this meteoric rise in GDP that everybody's talking about. We think things do normalize. We think that the banking and the loan situation is real, and it's just a matter of time before you have some negative net effect of kind of paying the piper, if you will. And there's a lot of things that could be catalysts for that. But no different than the Brexit. There's a lot of people rattling the sabers around, oh, if you have a Brexit, what's that going to mean for the U.S. economy? And Westbury, who's our chief economist, did a lot of great work on this, and he said it will be a non-event. Quite frankly, and although we may be in the minority on this, we're very much in the camp of China. If China goes the way and does kind of move towards more of a deflationary environment, the net effect on the U.S. will be minimal.
Yeah, and this is James. I would agree with pretty much everything that Paul mentioned. I think that China's growth trajectory is certainly diminished. That 8 or 9% target is now probably 5 to 6% at best. And as they try and shift demand from external demand to internal demand, there could be some building inflationary pressures, but I think they'll be mitigated. I think it's a work in progress, and given their ties to the global economy, particularly Europe, which is still struggling, I think that reflation in that economy is a relatively low risk in the order of macro shocks that could arise over the next year.
So with that, we'll go ahead and wrap up our session. I want to thank the panelists again for participating. We will make a recording of this webcast available shortly after. And again, thank you very much. And if you have any other questions, feel free to email us, and we can certainly follow up with you. Again, thank you very much for participating, and we'll look out for our next Advisor Success Series.